Let's welcome in Julian Brigden, Macro Intelligence 2 Partners co-founder and president. Julian, you just heard our Jennifer Schomburger lay out sort of the challenges ahead of the Fed chair here, not least of which is sort of convincing the markets, and not just convincing the markets, but actually succeeding at bringing down inflation without driving the U.S. economy into a recession. Do you think that that is achievable?
I mean, everything's achievable and it's been done before. It's just statistically not very likely. I mean, if you look at the last 12 tightening cycles, we've had 8 recessions. So those are your statistical odds. It isn't the base case, and yet it's what the market has utterly priced. We've priced, yet again, this quite sort of bizarre combination in the equity market where the equity market's going for full Goldilocks. We're rotating out of tech and we're going into small caps. We're sitting at absolute highs. And yet, when you look at the bond market, it's really, well, I wouldn't say it's pricing in a recession, but it's pricing in some recessionary-like rate cuts. And to see those, you would really have to see quite a deterioration in employment. And if you do that, you've got a recession. So we are at one of these sort of bizarre inflection points. We were there back at the beginning of the year. The result was the bond market got it wrong. Yields spiked. So we'll see whether that happens again. I'm a little bit more in the recessionary camp this time than I was back then. But it's a hard thing for the Fed to pull off.
Why, Julian? Why do you say that? Why in your words, you're a bit more in the recession camp?
Well, the thing is, Josh, is that the challenge with achieving a soft landing is balancing inflation while allowing the labor market to cool, but not cool too much that you lose momentum. And when you look at employment, it is really a very bizarre metric. Most financial metrics sort of chop sideways or they trend. Employment kind of looks a bit like the mountain range that we had behind your previous commentator. You get very, very sharp peaks, and then you get these sort of low valleys where you don't sit for very long. Typically, you don't track sideways for years and years in employment. It's either rising or it's falling. And we've been losing momentum in the labor market for a while. I think some of it is exaggerated by the illegal immigration story, which tends to, I think, over-exaggerate the level of unemployment. But nonetheless, we're definitely losing momentum. So the danger is that you leave it too long, and arguably the Fed has already done that based upon historical metrics. And even then, if you cut, it's too late. Because once you start to lose that momentum, you don't get it back again, even if you cut.
And even if you cut, I mean, will you also then sort of will the Fed's hand be forced to be more aggressive with the cutting? I mean, it looks like we're going to get a quarter-point cut, right, in September. The market is pricing in 100 basis points or percent by the end of the year, which would imply there's going to be a half-point cut at some point. Do you think that is even underplaying it?
No, I think, look, we don't have the layoffs at the moment, Julie. We really don't. So it's very difficult to say that we've lost that momentum. The momentum is waning, but we haven't got the layoffs. And until you get the layoffs, it's kind of hard to say you're sort of in that recessionary camp. I think it would take an awful lot to get a 50 basis point rate cut. I think you could get, in the event that we start to lose momentum, unless the numbers are catastrophic, which doesn't look likely, you could get accelerated 25 basis point cuts. So you could get 25 every meeting. 50 is going to take a lot. And if they cut 50, the equity market may think they like that. They're going to hate it because you'll have lost employment momentum at that point. And I think a recession would be guaranteed. And by the way, the average decline of the equity market in a recession going back to 1930 is 30%. And we're certainly not priced for that.